So with that being said, once you have a clear understanding that you want to see yourself within the commercial space, now then it's up to you that how do I really get there in its most practical way.
So now the value of commercial properties is valued at the income that I'm getting. So say for instance, if today we're speaking about real stuff. We're speaking about the 3 types of properties that you can actually invest in.
Yeah, so what we're basically doing today is that we're looking at real estate as a topic, and then we're breaking it down, the different types of real estate that one can invest in. It's very important that we know which type of real estate investment category are we in, so that we can understand the rules in the game of how the big guys are playing that game. So there are 3 types of real estate when we're looking at the classifications. Number 1 is residential, number 2 it's commercial, number 3 is industrial. Level, I have a question for you, right? Looking at the 3 types of real estate investments, which is residential, commercial, and industrial, which one is your favorite and why?
I mean, right now, I haven't really invested in it, right? However, I'm looking at commercial, right? Now, the reason why I'm saying commercial is because now, if you're looking at it, if you take, for instance, right now, I'm taking a property, right? I have a property right now on me, and I'm only getting income from one person, right? So I have my person that's renting out my property. I'm totally dependent on them to actually give me the cash flow. However, once I start going commercial, this basically means that if that one person goes out, I still have many more people that are within that particular property. So that's why I'm saying that, you know what, commercial might be the right one for me. Now, what about yours?
No, man. There's another point, and it's a very, very important point, that the reason why you love commercials, I'm not sure is that are you shy because you see the cameras or what. Let me take us through when it comes to the income, right? And especially increasing it, how does that affect the value of your property as a whole versus your normal residential?
Okay, so now we're speaking appreciation.
I knew that it's deep within.
So now we're speaking appreciation, right?
Yeah.
So now if we're speaking appreciation on a property, we need to understand that how do properties appreciate with value, right? So now you find out that with residential properties, they appreciate once everybody in that area is selling properties above what is actually on the market right now. So say for instance, right now, there's going to be the first one that's saying that I'm selling my property at 850,000, right?
Okay.
Now, with this person that's selling their property at 850,000, once the next door neighbor says that I'm also going to be selling my property at 850,000, now it becomes a trend of people selling their properties at 850,000. What does this mean?
So can we say in a market whereby maybe it was at 750?
Yes.
So now there's that one guy who was like, I'm a risk taker at
Yes.
800. Okay.
So now in that way, you can see that the trend in that particular area have actually increased the value of the properties in that area. Now, let's look at your commercial. So now when you're looking at commercial value of the commercial space is actually determined by the income that you're actually getting. So now the value of commercial properties is valued at the income that I'm getting. So say for instance, if I'm having a property and now my rates or my rental income, I'm going to increase my rental with around, let's say 200 on a monthly basis. Now what that does is that,
Rand.
yes, 200 rand.
Okay, let's see
So
how
now-
that affects us.
Okay.
I'm just getting my calculator.
So now what that does is that the income that I'm getting is more than what I had initially gotten. So say for instance, let's look at a property with 40 units, right? Let's look at a property with 40 units. So now if you're looking at a property with 40 units, that means that if say for instance, we're collecting rental of, let's put 4,500 on a monthly basis. So now the value is going to be...
Is this for each
for each one, right? So now I'm going to say 40 multiplied by the 4,500, which means that the income that I'm getting from this property is 180,000. Now that's something that's called a cap rate, right? So now a cap rate,
I knew this was
you
deep.
knew it's coming.
Your numbers person.
Of course. So now cap rate basically tells you that if you bought the property cash, how much or what is the percentage that you're going to be getting from that particular property. So now say for instance, if your cap rate is sitting at 12%, right? Now, what we're going to do right now, we're going to check that by how much can we actually increase the value of the property by, right? So now we said that we're increasing the value by 200, right? So now we're going to say 200.
I mean, it might seem like it's not much.
It's not a lot, right?
Yeah.
So now we're going to say 200 multiplied by the number of units, right? So 200 multiplied by 40 will give you 8,000, right? Now,
I like it when you do that.
right. So now, when you're looking at the 8,000, you say 8,000 multiplied, no, not 8,000, to 200 rand, right?
Yeah.
200 rand multiplied by the number of units. So 200 multiplied by the number of units, you get how much extra income are you actually getting, which is 8,000, right? So now we say 8,000 multiplied by 12, because now remember, rental apartments or rental units or whatever, when you're speaking about investments, especially when you're looking at rental, it's always calculated on an annual basis. So we say 8,000 that we're getting monthly, that is the additional income, multiplied by 12, this means that we're getting an additional income of 96,000, right? Now, this 96,000 will then be divided by the cap rate that we spoke about earlier on. So I'm going to say 96% divided by the cap rate of 12%. We spoke about 12% earlier on.
96,000.
Yeah, 96,000.
Yeah.
96,000 divided by 12%. So now when you're saying 96,000 divided by 12%, you're getting 800,000. So what does this mean? It means that you have actually increased the value of the property by 800,000. Now, this is where it becomes, or this is where we need to look at how do we match what's going on the ground and what's going on the numbers. Yes, you might say that I've increased the value of the property by 800, but as much as you increase the value of the property by 800, are people willing to purchase that property with an additional 800,000? Now, say for instance, if we bought the property at, let's say, 5 million, now we're increasing the value of the property by 800,000. Now, the question would be that, are people willing to purchase that property that you increase the value of at 5,800,000? Now that's where it becomes different. So now we need to understand that with commercial property and with your normal properties, these won't be actually done the same or valuated the same. So now with your commercial property, yes, you do have a little more control over the value of the property. Whereas with your residential, putting in the pool does actually increase the value of the property. However, it won't increase it significantly high, whereby you see that we bought the property at 700,000, I put in the swimming pool, now I'm able to sell it at 1 million, right? In a property that's selling properties at 700,000, that might not be correct.
Yeah, 100%, man. Even the thing about the different types of property, even your approach towards it. Because I remember when we were looking at your commercial, right, your commercial space, and when we were viewing it, and also because there's some clients of ours like, gents, I'm interested, so how do I position myself? So if you want to understand how do you position yourself, if you're looking at residential and you want to start investing, do hit us up in the emails, or just book your Zoom meeting in the Calendly link, and we'll be more than happy to assist you with that. So going back to the type of information that will assist you when it comes to making a choice, where commercial versus residential, is that when it comes to commercial, because I'm buying it as a business, I have the right to ask for the financials. Because now I'm buying the business behind it. I'm not just buying the 40 units.
Yeah.
Now that's what I like, and this is what we always emphasize, in that a lot of people, when it comes to residential, they're not using these principles. So can you imagine how dangerous it is that you bought an apartment because it has a jacuzzi, it has a 2-room, so that's why you bought it. Whereas the commercial space, the guys are not speaking about that, as you did here earlier on, the cap rate. So you can see that the commercial guys are playing very strategically. So it's very important that when it comes to us as residential, that we really need to understand how these guys are playing the game, so that even if it's on a smaller scale, I can still apply these rules so that I can be able to scale. Because we've seen that with a lot of situations, that you find somebody in residential and they're finding it very difficult, not only because it's intimidating to move to commercial, but because they don't have an idea of how do I position myself. The commercial guys will come to you and say that if it's cash flow negative, I don't understand why should I be buying a business that's cash flow negative. Whereas somebody in residential, they'll buy cash flow negative. So then you really ask yourself that, what do we really want out of this property?
Yeah.
And I must say, man, when I was looking at the financials of the commercial, especially if you don't know numbers, trust me, you've got about 8 pages and you just see general ledger. It's like it's taking us back to high school. At the end of the day, what I'm saying is that we've always been saying this, that when it comes to property investing, it's a numbers game. It's very important that we understand the numbers and we can balance at the end of the day.
Yeah. Now, what is your blueprint, or how does your blueprint go in terms of you, where you are right now, and how do you get to the desired goal that you want?
Yeah. I mean, it depends on an individual, right? Because somebody will be like, I'm happy with residential. Somebody will be like, I want to tap into commercial space. Someone will also be like, I want to even take it further and take it to industrial. We really need to understand where do we want to take it. So with that being said, once you have a clear understanding that you want to see yourself within the commercial space, now then it's up to you that how do I really get there in its most practical way. So then let's look at it again when it comes to numbers then. If I'm understanding that I cannot afford commercial, a property of 14 million right now, the question now is that how do I position myself? There's different ways that people are positioning themselves to own these commercials. Some people are coming through as a group that, you know what, if I can afford 1 million, then I get similar people to me, like 13 people, and then we buy this commercial, it will get me there. So that's how some people move from residential to commercial. But now there's a huge problem if we are not aligned as a group. That's later going to catch up with us, because it might be that I see a commercial of 14 units in Cape Town, and then someone sees a commercial unit within Joburg, and then now it's actually a fight that why are we buying the one in Cape Town and not the one in Durban? And now it goes back again to what we always saying, that the numbers are very important, because they will be directing us that which one is really better. Because even with commercial, you can look at 240 units, but you still have more potential on the one versus the other one. Or sometimes, here's the funny thing, right? You can see that one is aesthetically beautiful, but one which is not so developed. I'm not saying it's in its worst shape. I'm saying that it's not so aesthetically developed, but then looking at them, this one is a no-brainer. So even us coming together, the 14th of us, we still need to be on the same page when it comes to our mindset, so that we do not make any mistakes. And again, if you are a group or a stokvel, or you want to buy with your wife or your friends, we're saying that our gates are open, and then we are willing to sit down with you and rather strategize in terms of how do we go about it. The other way, of course, would then be, how do I take little steps that will ultimately lead me to that bigger goal? So when I'm saying little steps, I'm saying that, okay, how do I buy a cash flow positive property when I'm looking at my financials under my business? It's going to enable me to buy the next one. Because now how the bond originator looks at you, let's be honest, let's just break this down as simple as possible. If you're applying for that first home loan, they're going to be looking at your income versus expenses, then cash flow under personal capacity. And then that's when they'll take that step that, yes, you can afford this house. So every time I'm buying a house, a property as an investment, I need to be asking myself that, can I buy my next property? Lebo, what would you say that when it comes to residential, a lot of people would say that I wouldn't want to start with commercial or industrial. I'd rather start with residential, which is the first type of classification when it comes to real estate. I mean, this sounds good. What would you say are the risks associated with investing in residential?
When you're looking at flip, it makes sense, right? But now when you're looking at renting out, this is where it doesn't make sense. You're renting out a property to one family. Now this basically means that your income is dependent on that particular family. So now from that particular family, once that family moves out of the property, your vacancy is now at 100%. Now that's where the thing is that I don't really feel comfortable with. Having my vacancy on or trusted on this one particular family that we have on this property. So my main risk of your residential is that if one person goes out of that property, this basically means that I'm not getting any income from that particular property. Now what you'd want to do, let's not even go to your commercial, right? There are your houses whereby there's a house and then there are back rooms or rooms that have been built. Now, I'm not really encouraging that if it's not approved by the municipal. Once it gets approved by the municipal, that's when we can say that let's go. The reason why is that, say for instance, you have a house and you have 3 rooms at the back. Now we're not looking at 20 rooms, we're just looking at 3 rooms. If you're collecting 2,500 from each, that's 2,500, that's 5,000, plus another 2,500, that's 7,000. Looking at the income from the property, you could also be getting 7,000. Now that's a total of 14,000. Now looking at those type of properties, you are ranging at around 600,000, 700,000 to purchase that property, which basically means that you'd need all 3 people to actually rent out the property, and then the person that's living in the property can move out and you'll still be able to actually break even. right? But now where the problem is that if you're only reliant on one person to actually pay you on a monthly basis, then when that person moves out, then you need to actually pay that monthly bond.
I mean, we need to understand the different types of residentials, because now when we're looking at the different types of residentials, we understand that there's residential 1, there's 2, there's 3, there's 4.
Yeah.
So now when I'm looking at residential 2, 3, and 4, it does enable me to capitalize on getting more people, whether I'm building bachelors that are approved, of course. So looking at it in that way, I still can run on a cash flow positive. But then now I really believe that with what you explained earlier on, right, in terms of when we're looking at commercial, I, as the owner, especially if the property is in good condition, right, I do have influence to some extent of appreciation. So now when I'm looking at residential, on the contrary, as much as I can sometimes build other rooms or other bachelors at the back, whether it's 2 or 3, and then now only to find out that my total investment was about, let's say, 800,000 on top of what I bought it for. So now I'm at the stage whereby I want to sell this property, but now I do not have those rights. I do not have those rights. So it's not registered under residential 2 or 3. So now I'm in a situation whereby I know that I invested 900,000. So let's say the 800,000 to develop, and then the 100,000 to acquire the property. So now I know when I'm looking at my bank account, I know that 900,000 did get into this project. But now I'm in a situation whereby I can't get my money back. I can't get my money back. So I'll say that that's a huge risk when it comes to residential that a lot of people are not aware of. They thinking that if I develop, 100% sure I'm going to get my money back.
Of course.
Of which it's not the case.
Yes, that's a problem, eh?
It's a huge problem.
That's a